This program is brought to you by the following proud sponsors. The Alltech Media Group, the region's leading multimedia video production and marketing company, creating powerful and innovative marketing strategies that deliver exponential returns. And by California CEO Online Video Business Magazine, providing California's executives and regional leaders with economic development resources and regional branding solutions. And by StudioCast Pros, taking your web branding strategies to a new level by creating world-class online programs proven to engage audiences and enhance profits.
Hey everybody, and welcome back to 1 Million Cups. My name's Jay Goth. I'm one of the co-organizers of the Million Cups Riverside, and today I'm taking off my co-organizer hat, taking off my plastics recycling hat, taking off my Insocal Connect hat, and I'm putting on my investment banking hat, and I'm going to talk to you about something that everyone wants to know about, and that's crowdfunding. Everyone's heard about crowdfunding, and they've heard all the success stories. This was one of the very first success stories. This is a company called Pebble. They created an internet watch, a smartwatch, and they wanted to get $100,000. They raised over $10 million in a crowdfunding campaign. And what they were doing was basically pre-selling the watch. They were saying, we want to build this really cool watch. We don't have the money. If we can raise 100 grand, we can get to production. And everyone wanted the watch. It was a big success. Here's another company. This was a video game maker. They wanted to raise $400,000. They ended up raising over $3 million because people wanted to get the video game. They had over 87,000 people who wanted that video game, so they were willing to fund the development of a video game. Then there are the not so successful ventures. This is a company that was also developing a video game. They only wanted to raise $6,000 and they got to $700 with 2 hours left to go. They're not going to make it. So there are some key elements to being successful in crowdfunding. First of all, you have to have your entire marketing campaign set up before you launch your crowdfunding effort. I have seen so many companies get into trouble. What they do is they launch a crowdfunding campaign and then they tell all their friends. They say, hey, I just launched this crowdfunding campaign. You need to go online. No, you have to tell your friends months in advance. I'm going to launch a crowdfunding campaign on December 1st. And when I do, you need to come on board and buy something and contribute to my crowdfunding campaign so that I can look good to Kickstarter or Indiegogo or whatever platform I'm on, so that they push me up near the top of the rankings so other people hear about it. If you don't do that, nobody's going to know about it. You're going to try and go to your network and it's going to fail. What you need to do is you need to build your network ahead of time. You need to get some influencers involved, bloggers, PR people. You need to make a big splash the very first day. That's the key to success in crowdfunding. So that's the marketing side. Now let's go to the dry, boring stuff, which is what is crowdfunding, how does it work, and would it actually be good or bad? There are pros and cons to crowdfunding. First of all, crowdfunding today is not legal. You go, wait a second, I hear about crowdfunding, I've seen all these guys doing crowdfunding. Well, the fact of the matter is, unless you're funding through accredited investors only, you're not allowed to crowdfund. You can pre-sell products, you can get people to donate, that's what Indiegogo and Kickstarter are all about, but you cannot provide equity in exchange for dollars unless these are accredited investors and you can prove that they're accredited investors. So when people say, well, I've heard that there are crowdfunding equity sites out there, yes, there are. This is one, MicroVentures. This is an actual broker-dealer in Texas who has developed a website where you can put your business plan up. They're going to charge you a due diligence fee to review your plan, and then they show it to their accredited investors and they can invest in your company. Another one is EquityNet. They are also a place where you can build your business plan online and you can submit it to accredited investors and they can invest, but they have to be accredited. Accredited means you have to have a net worth of over $1 million a year or $1 million, and that excludes your house, so you can't include your personal residence, or you need to make $300,000 a year or $200,000 a year, sorry, and you and your spouse together have to make $300,000. So if you each make $150,000, then you qualify as a unit. So that's for accredited investors only. You say, well, wait a second, I heard all this stuff about the Jobs Act. It was passed years ago, and it was supposed to allow everyone to crowdfund. Well, the problem is the SEC is still developing the rules for crowdfunding. So while they've passed rules for Regulation A, which is a whole nother topic, and they've passed rule changes for Regulation D, which allows people to now general solicit accredited investors only, which is what the guys are doing on those websites I was talking about. They have not come up with the changes and the rules for crowdfunding. And that's a big problem. There are general guidelines that Congress passed. So in the Jobs Act bill, they've set out the general guidelines, but the SEC has yet to set those in stone so that you can offer anybody in the world stock in your company for money. So basically, under the general rules, you can raise up to $1 million per year through crowdfunding. You can advertise over the internet. That means you can put something out there that says, hey, we're raising money through a crowdfunding campaign. Go to XYZ portal and check us out and invest in us. You can do social media, so you can put it on Facebook. You can put it out through Twitter. You can get that viral effect of people sharing the fact that they saw something really cool. Maybe you should go invest in it. But you can't actually put your offer on your website. You have to go through a portal, and I'll explain that in a minute. So originally, the SEC was going to come up with rules within 270 days. That was in 2012. September of 2012 was when they passed the law. We're in 2014, and I don't think we'll see SEC regulations on this until sometime next year. And with the political things going on, who knows when. So one nice thing is, if you do a crowdfunding campaign, you're exempt from state registration. Although states may require that you get a license to do it, and they may require that you do notice filings. So you're not completely exempt from state regulation, but you don't have to actually register your stock with the state. You are not exempt from anti-fraud. That means what they are really worried about are people putting up websites, crowdfunding for something that doesn't exist, taking the money, going off, doing another crowdfunding. It's like multiple Ponzi schemes. That's what they really worry about. So that's something that they're really going to be enforcing. One of the important parts of crowdfunding is anyone you do through a crowdfunding campaign is not counted as a shareholder of record. And you go, well, what do I care about that? Well, it's very important because if you go over 2,000 shareholders, and in a crowdfunding campaign, you might get 10,000 people investing $1 each in 1/10 of a share of stock or something. Then you have to be a public company, and you have to do public filings. And that means you're going to be paying somewhere around $20,000, $30,000 a year just for the privilege of having to report everything you do to the government. But if you do a crowdfunding campaign, you're exempt from that, so you don't have to count those as shareholders, so it doesn't count towards that public registration. You can only sell a certain amount to any single investor. You can't have Uncle Bob bet his farm on your new idea. So basically, if you have a net worth of under $100,000, you can only invest $2,000 or 5% of your net worth. If you have a net worth of over $100,000, you can invest 10% up to $100,000, but that's aggregated. So that's over a number of different crowdfunding things. Who's going to regulate that? Who's going to know if I invest in this company, and this company, and this company, and I go over this threshold? Who's going to know? Who's going to be responsible for telling me I can't do that? Well, that's up to the SEC to figure out. Now, like I said, you have to use an intermediary. You can't go out and crowdfund on your own. This is one of the regulations they have in place to protect us from that multiple Ponzi scheme I was talking about. So you can go through a portal. You can go through a broker-dealer, which is a registered investment bank, or an SEC-registered intermediary. You go, what is that? Well, it's somebody who registers with the SEC and says, I'm going to be doing crowdfunding on behalf of clients. I'm going to charge them money. And then the SEC knows what they're doing, and they can keep an eye on them. So if you're a portal, if you're one of these intermediaries, you cannot solicit investments. You can't go out there and say, hey, invest in these great companies. You also can't offer investment advice. You can't offer any of your employees compensation that's based on raising money. So you're not becoming, a boiler room. You're basically just becoming a portal where you can list companies that are offering equity for sale and manage the transactions. You cannot actually hold or manage the funds themselves. It has to be directly between the investor and the company, so there's no shenanigans there. You're simply a conduit between the two. So, as a portal, you have to tell the SEC everything that happens on your website. You have to provide certain information to all the investors. You have to give them guidelines. You have to ensure that they're not investing money that they can't afford to invest. How do you do that? That's up to the SEC again. No wonder they're taking so long to come up with these guidelines. I mean, you're talking about a lot of stuff. You have to send out a questionnaire and make sure they sign it, affirming that they can lose the money that they've invested. You have to make sure that no funds are released until the crowdfunding thing is done. Well, if you're not managing the funds, how are you going to ensure that the money is released? There's got to be some kind of escrow, and even though you can't control the escrow, you have to oversee the escrow. And you have to monitor investor limits. This is that question I was coming back to. Who knows how many companies you're investing in? If I go through 5 different portals, do they have some kind of master portal overview that tells me how many investors are investing in what deals? I don't know. So there are certain disclosures that a company has to make when they're crowdfunding. So if you're raising less than $100,000, you can get by with certified financials. What are certified financials? That means an accountant says, yes, they showed me their financials. I'm not making any decision whether they're right or not, but I have seen something that says this is our profit and loss statement. Between $100,000 and $500,000, you have to have reviewed financials, which means the accountant actually has to say, not only have I seen something that passes itself off as a balance sheet and profit and loss statement, I've actually reviewed them, and I believe that they're good. And then if they're over $500,000, you have to actually have audited financials, and that's a whole nother ball of wax. Because when they're auditing your financials, they're putting their name saying, these are the actual financials. We've seen every dollar that has gone in and come out of this company. That's expensive. So if you're raising over $500,000 in a crowdfunding campaign, you're halfway to being public, because that's one of the requirements for being a public company. So then, what kind of disclosures does a company have to make to these investors? Well, first of all, you have to show them what your capital structure is. How many shareholders are there currently? How much stock are you planning to offer? At the end of the offering, how many total investors will there be, and how much stock will there be outstanding? If you've got a company that's got 40 million shares outstanding and you're selling your stock at $20 a share, you're talking about an $800 million company that could be a startup, and these investors want to know, what is the value of this company? So the cap structure will tell you that. You have to tell them who the directors are, who the officers are, and who owns 20% or more of the stock, because they want to know. There can't be any bad actors. That's another law that was passed. That basically means if you've been involved in any kind of stock fraud, manipulation, if you had a felony, you're called a bad actor and you can't be included. So if you're listed in that description, you can't do the crowdfunding. You got to get rid of the bad actors. And that's always a good advice anyway, right? So you have to provide them with a business description, and you have to tell them how you're going to use their money. You have to come up with some idea of how you came to this valuation and what the risks are. So you've got to put in the risk factors. If you've ever seen a private placement memorandum, you will see that there's about 20 pages of boilerplate risk factors that almost every company uses. I've seen companies just take them from other companies because they're all pretty much the same. We could go out of business tomorrow. We may not get enough funding. Our product may, a competitor may come in and edge us out. It's all designed to scare off everyone but the most, confident investor. So we're getting down to the bottom line. Crowdfunding is a new way to raise money, eventually. And basically, it does provide you access to stocks that maybe you couldn't have bought before. If you're not an accredited investor, you've never gotten in on a Facebook or Twitter or Pinterest or one of these great companies that either went public or got sold for billions of dollars and everyone made a fortune, but because we're Joe Blow, we don't get to invest in those. Now you can. So there is an opportunity there for both of you, the company and the investor. You can utilize the power of the internet to spread the word about your stock offering. No one's ever been able to do that before except for the scammers who are out there, and we've all gotten those emails. There are less upfront requirements than going public, but there's still a lot of upfront requirements. Even if you do what's called a Regulation D, just a regular private placement, there are a lot of requirements involved in doing that, and you have to spend a lot of money with an attorney. In this case, you don't have all those requirements, but it's still not problematical. And like I said, the little guy can now get into a new issue. That's pretty cool. Now, what are the cons? First of all, you have to file an annual report with the SEC. You know what that means? That means that it's a public document. That means that everybody in the country can read about what your company's doing. So all of a sudden, it's like public reporting. It's not as extensive. You don't have to go into all the things, but you do have to tell them what you're doing. You also have to provide an annual report to the shareholders. I mean, if you're a company and you've got shareholders and you're not doing that, I would say you need to rethink your model. But this is a requirement. I've talked to a lot of broker-dealers. Being in the investment banking world, I know that there are some groups of people that have said, I will never invest in a crowdfunded company because the cap structure is so diluted, it's just impossible. I've talked to other groups who have said, we've set up a whole division waiting for crowdfunding to happen so that we can do follow-on investing. So there's a bifurcation there in the market. It'll be interesting to see what happens. The biggest problem I see with this is if you have 5,000 investors, every investor is going to want to know what's going on. So you're going to have communication issues. I raised $60 million from 1,500 private investors for one of my companies. I got calls every single day from investors. I didn't get the calls from the guys who invested $250,000 or $500,000. They were professional investors. They knew they were putting their money away. It was going in a dark hole. If it came out, it would be bigger. If it didn't come out, it was gone forever. The little guys who invested $10,000 were like, Jay, when are we going public? What's happening? I need to get my money back. You're going to have a lot of those guys if you do crowdfunding. So that's one of the biggest problems I see. So basically, that's it in a nutshell, and I'm open for some quick questions.
So I'm a little confused between the term crowdfunding, because when you first began and you showed example of crowdfunding, that wasn't an investment crowdfunding. So there's a difference between an investor crowdfunding and a pre-buy a product or donation crowdfunding.
Correct.
So you were kind of referring to the crowdfunding where you're looking for investors.
Right.
Say you're a blogger and you're creating your own online blogging or podcast site, and say it's political in nature, and you want to grow it, you want to grow a journalist staff and grow your way to deliver the message, can you ask for donations to help you grow your quote online podcast site?
Sure.
And that you don't have to do any of it?
As long as you're not giving them a piece of your company or any kind of equity, you can do that, because that's a donation. That's what Indiegogo is, really a website for independent artists and people like that to raise money for projects. So that's a great example of what you're talking about, is that would be somebody who's got a project, needs to fund it, doesn't have enough money themselves, and is looking for donations. That's totally legal, and people do that every day.
So if you were a self-published author,
Right.
and you were about to launch a book,
Mm-hmm.
and you went out and did crowdfunding, and you said, hey, I'm about to finish and self-publish my book. If you'd like to pre-buy a copy of it, send this. So would that be a donation, or you just a pre-buy?
That's a pre-sale,
A
yeah.
pre-sale of my book.
And that's perfectly legal. You can do that today. As long as you don't say, I'm going to share the profits
Right.
of my book sale with you, because all of a sudden that becomes a security, because you're making a promise against something that'll happen in the future.
Right.
And you know, a lot of people get confused about what is a security, but anytime you take money and you make a promise to somebody for something in return later on, whether it's say debt, you take a note and you promise them their principal back plus interest, that's actually a security. A lot of people don't think it is, but it is. So a lot of companies will take promissory notes, and they say, well, we're not giving up equity, so we don't have to do anything on the corporate security side. And I'm not an attorney, disclaimer, but if you talk to a corporate securities attorney, he'll say, whenever you take in money and you're making a promise that they're either going to get their money back or there's some kind of security interest in it, that's a security. And you need to make sure that you're compliant with your state and federal regulations. Yes?
So how do you manage the size of the investor? You mentioned at the end that the possibility of having a lot of small investors can be very, very time consuming because you're answering questions and communicating with them. Are you able to set a minimum investment size to try and control that, or is it not allowed?
You know, I would say right now, with the SEC still writing the rules, that it's not determined, but I would think in common sense terms that if you wanted to do a crowdfunding offering, you could set the general parameters and say we only will accept amounts of this much or more. But it's going to have to be pretty small, because as you could see, investors can only invest up to $2,000. So, you know, you're stuck with that. That's one of the nice things about doing a regular private offering, is you can do your own due diligence on the investor, and you can accept which people you allow to invest in your company. Whereas with crowdfunding, they're going through a portal. You don't know who these people are. You're just taking in money.
Now I have a question on the non-investment crowdfunding, on an accounting side. I create my online blog or my online radio show, and I've got $100,000 in donations. How do I account to that? Is that taxable income because it was a donation? Is it non-taxable? I'm really lost here, because again, because I'm not delivering a product, it's more of a service.
Right. Well, I am not an accountant, so another disclaimer. But I would think if you're pre-selling something, that would be revenue. If you're taking it in a donation, then that would be some other form of income, and I would have to talk to my accountant on how I would classify that, because I don't know what it is. Honestly, I don't know. I'm not an accountant.
I can understand that pre-sale, you have to charge taxes, but donations, that would be a whole different.
That's a whole nother can of worms. Yeah.
Another question. The portals are not allowed to base their employee compensation on the success of the campaigns, but they're probably going to be linked in some way. If not directly, it's going to be indirectly, because if there are a lot of successful campaigns, then the portal will be bringing in more money. Therefore, the portal will be able to afford to pay their employees more. Is there any more specifics on exactly how what they have to avoid?
I think, and that's a good question, and I don't honestly know the answer, but I would think, common sense wise, again, if you're an hourly employee and you're paid by the hour, and the company is successful and they want to pay you more, that's okay. But if I'm an hourly employee and at the end of the year the company says we did great and we're giving out everyone big bonuses based on our success, that may not be okay, because that would be a form of compensation based upon the money raising. Whereas if you're an hourly employee and you just get raises over time, I would think that that would fit.
And when you talk about a portal, if you're not doing the investment type of crowdfunding, do you still need to go through a portal? Like those 3 companies you showed, did they have to go through a portal, or could they just do it from their own social media site?
There are plenty of people that raise money through social media, just saying, they have a Facebook page and they say, I do this, or maybe they're selling a product. It's the same thing, right? So you put your product up on your Facebook page and you sell. It's the same thing as being a blogger and asking people for donations on a Facebook page. So you can do that. Although, Kickstarter or Indiegogo, people are going there looking for ideas to put money into, right? So that gives you a little advantage.
They're looking more for the investment side than they are, say, they just...
Not on Kickstarter, because they can't get investment, right? They still have to, they're looking to get in on something cool. That's what Kickstarter's all about is, GoPro, I want to get the next GoPro before anyone knows about it. That's what Pebble Watch was all about. I know a bunch of people who bought those things. They had no idea if it was going to work or not. They had the money and they wanted to. I know one guy who bought 5 of them, before they even had a product.
Jay, I see a lot of sites popping up now that help to prepare campaigns to enter into those crowdfunding places, portals. What's the legality of that?
As far as I'm concerned, they're just marketing companies and they can go to town.
But if they're charging fees, isn't that?
They're charging you fees for marketing, not for directly raising you money, right?
I thought, I could be wrong, but I thought that they were saying that they were making some guarantees that you would raise some funding.
Well, if they're doing that, then they're acting as a broker-dealer.
Yeah.
And that's illegal.
Okay. Yeah.
Yeah, they can't guarantee that they're going to raise you money. As soon as somebody says, I will get you investor money, they're acting as a broker-dealer.
Crowdfunding money, right?
Crowdfunding is a different thing, but right now crowdfunding is only through Kickstarter, Indiegogo type deals where there's no equity involved. So in that case, they can do that.
Right, so if they...
But if they were to do that for a crowdfunding equity site and guarantee that they will get you money on a crowdfunding equity site, they can't do that because then they're helping you raise money. But if they say, we will provide the marketing that will get you traffic to your crowdfunding site, so that's they're going to have to talk to their attorneys, and I'm not a regulator, believe me, so I can't answer that. Well, thanks everybody. I know we're out of time, but hopefully this has been helpful. Come back to Million Cups. We'll be here again next week, Wednesday morning, 8 o'clock, every day, rain or shine, unless it's Christmas Eve, which is what it is this year, so we won't be here that Wednesday, but every other Wednesday we'll be around. Thanks.
This program was brought to you by the following proud sponsors. The Alltech Media Group, the region's leading multimedia video production and marketing company, creating powerful and innovative marketing strategies that deliver exponential returns. And by California CEO Online Video Business Magazine, providing California's executives and regional leaders with economic development resources and regional branding solutions. And by StudioCast Pros, taking your web branding strategies to a new level by creating world-class online programs proven to engage audiences and enhance profits.